Good morning, I'm Tyne Morgan at our Farm Journal studios here in Kansas City. Clinton Griffiths has the day off. Is the ag economy heading toward a recession? There are several warning signs starting to show up, according to the head of the Chicago Federal Reserve. As we first reported on Friday, the latest Rural Main Street Index out of Creighton University shows ag lenders are concerned. One banker even saying that farm operating loans are up 20% in total volume compared to last year, which is a sign that cash flow and cash balance sheets are down from last year. As the Federal Reserve looks to tame inflation, interest rates remain high, and certain industries are getting hit hard by the higher for longer interest rate environment, including ag equipment makers. And a possible recession is now a growing concern in agriculture. Earlier this month, the Federal Reserve stayed the course, leaving interest rates unchanged. The news didn't come as a surprise to many, as taming sticky inflation has proved to be a challenge despite promising inflation data also out this month.
Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high.
We spoke to Austin Goolsbee, President and Chief Executive Officer of the Federal Reserve Bank of Chicago, one-on-one just 2 days after the Fed announcement.
We got excellent news, at least for 1 month, on inflation, but that follows on failures on inflation. So we have to make progress on inflation before you're going to see rates coming down to something like normal levels.
The June Ag Economists Monthly Monitor, a survey of nearly 70 ag economists from across the U.S., asked the economists just how many rate cuts, if any, we will see this year. 73% said one, 18% think 2 rate cuts are possible this year, and 9% say 0. The future of interest rates hinges on inflation. So what's driving it?
There's 2 parts of the inflation. One is it just got way too high. And then the second is it's proved more persistent and stickier than what we thought. I think a big component, and you see that in the ag economy here in Iowa, has been input costs and the supply side damage.
But the ag economy and the U.S. economy are currently on different paths. Just this month, John Deere announcing it's offering early retirements and eliminating 650 total jobs across Iowa, with more cuts possibly on the way. Bridgestone America is also announcing this month it's laying off 118 workers at its Des Moines, Iowa plant, citing lower demand for ag tires.
I think the ag economy is a little bit a different story than the general economy. And partly we're readjusting. We just went through 3+ years that were extremely unusual and in many ways very strong for the ag economy. So part of this is getting back onto a more normal set of circumstances, and we're going to have to adjust to that.
The Chicago Fed also produces an ag letter looking at credit conditions across their geography. In May, the letter showed district credit conditions weakening in the first quarter of the year, and demand for non-real estate loans were also up from a year ago, while the availability of funds for ag lending was down.
Right now, repayment rates, if you look at delinquencies, they're rising. They're not to levels that you would call a recession, but they're rising. So I think that's an area of vulnerability.